You're the kind of investor who focuses mostly on one thing or everything. Well, my next guest is firmly in the latter camp. Fundamentals, technicals, economics, monetary and fiscal policy, and stocks naturally, but also bonds, currencies, commodities, and more. If you see the work he and his team put out, you know how comprehensive it is. Now it's time to learn from him what he's seeing in this market and what you should be looking for next. His name's Paul Hickey, and he's co-founder of Bespoke Investment Group. Paul, thanks for joining me today. So, Paul, glad you could join me here. I know I haven't had you in the podcast before, so why don't you talk just a little bit about your background and what it is that you do there at Bespoke?
Yeah, so I mean, I think what we do at Bespoke, what the best way to describe it is we do a fusion approach to the market where we look at historicals, we look at quantitative aspects of the market, we look at fundamentals, and we look at technicals, and we put that all together based on the premise that, following solely one discipline and towards the market and applying it can lead to errors. But if you look at it from multiple angles and you get agreement across these different angles and disciplines, it can improve your odds of success. And so what I learned in my first job out of college was, working on an emerging markets desk, trading desk. And when this was in the late 90s, when Thailand's currency was imploding and emerging markets were in flux, the US stock market was doing great. And then about 4 or 5 weeks later, the news started to leak out that Thailand was falling apart, not necessarily leak out, but people started paying attention to it more, and that caused it. So we just feel like as long as we can look at the market, our primary focus is the equity market, but recognizing that you have to be aware of every aspect of financial markets, geopolitical issues, because they all come back and find their way and price into equities.
Yeah, I'll tell you, I look at the research you put out. It's technicals, it's fundamentals, it's overseas, domestic, asset classes, market timing. It's kind of the whole gamut. So, I mean, how do you keep track of that all? And is there anything in this market that you think is particularly important for investors to focus on?
Yeah, so I mean, I think this is obviously, to say this is an interesting time would be an understatement. We're looking at we've seen record volatility in April. It's one of the most volatile months in market history, and that has really caused some big moves. But just taking a step back a little bit, coming into this year, we came across after 2 great years in the market, back-to-back 20% gains. We saw over 50 new highs last year in the S&P 500 on a closing basis. The S&P 500 never closed below its 200-day moving average. And all those are great in the moment. Yeah. But eventually, those types of environments don't last forever. And coming into this year, we didn't expect the type of volatility we're seeing now and the type of declines that we saw in April. But we were cautioning that the gains will be harder to come by, because following prior years when you saw that many new highs, like an average of once a week, or you saw the S&P 500 never close below its 200-day moving average, forward returns in the next year tended to be weaker than average. So it was a little bit of caution. No one expected what happened this year, especially on Liberation Day on April 2nd. And so that was a very big surprise to the markets and to investors. And I think the market reacted correctly and swiftly and gave a big smack in the face to the policy of the administration on those what were called at the time, reciprocal tariffs that were being nice.
Yeah, it's funny. I came into this year kind of expecting more volatility, just the way that the Trump administration does policy and handles that, not from a political stance, just there's surprises. It's not sort of the traditional way that Washington does things. And it's interesting. I didn't expect volatility like this. So I'm kind of curious, I think you had a recent TV appearance where you suggested this may be, we may have seen the worst of it, sort of this post trade tariff sell-off. So I'm curious if you can talk a little bit more about that. Do you still think that's the case?
Yeah.
And if so, why?
I think so. So, again, so this is a somewhat unique period because we could wake up tomorrow and tariffs could be set at, 100% for the world. And that would obviously cause markets to fall apart quickly. We're in this weird situation where just one Truth Social or tweet can cause problems. So that's something to keep in mind. But looking at the market, we always say this time is different. People always say this time is different, but in reality, the market has been there, done that, and has seen these types of moves. What we think is unique has seen things similar in the past. So what we're always doing is we're listening to the messages of the market and getting back to what your original question about volatility. Volatility, we saw a record spike in the VIX, and we saw a almost a record decline in the VIX over such short periods of time. Historically, that has led to forward. That is usually meant when you see that decline in the VIX that the worst was over and market returns were positive going forward. And just in the last 2 weeks, or last week, we saw a back-to-back-to-back, a three-peat of 1.5% gains in the S&P 500. That's very uncommon. But when you look back historically, about 10 other times, I don't remember the exact number of occurrences. But since following those types of gains, over the next year, the S&P was positive again every time. And it was an average return and a median return of over 20%. And so again, that's another item. And then lastly, we also saw the NASDAQ 100 breadth was every stock in the NASDAQ 100 was up one day last week. And that's the type of situation where you see this rush into buying into the market has usually been a sign of, gains that are enduring and a rally that will have some endurance to it rather than just a flash in the pan.
Got it. Well, the Kansas City Chiefs couldn't get the three-peat done, but it's good to see the S&P did, right?
Yeah, exactly, right?
Yeah. Let's talk a little bit about economics, Fed policy, and so on. I mean, I've seen a lot of headlines thrown out. The most recent one you called out was the Dallas Fed, worst since COVID, or this indicator is the worst since GFC, and so on and so forth. I mean, is it just because things were such a shock, or do you think we are going to really have a lot of sort of hard data economic fallout from what's been going on here?
Well, so this is what the really fascinating part is about it. You hear this discussion, like you just mentioned, what we spoke about with the Dallas Fed. This is the survey-based soft economic data, which has been very weak for months now. And what we've been waiting for is this soft data to make its way into the hard data, and we haven't quite seen that yet. And so that's the divide that that most people are expecting to converge. And quite frankly, we would expect some convergence there, but no one knows the future. And so what we're constantly monitoring is right now, especially, is jobless claims, which we see every week. And surprisingly, they've been pretty firm, and we haven't seen a big uptick in the jobless claims. And secondly, with earnings season, we're looking for earnings results. With each earnings report that comes in, we're getting another breadcrumb as to what is going on. It sort of reminds me of back during COVID when we would watch the case count updates every day. And if it was a big uptick in cases, the market would sell off. And if it was a low number, the market would rally. And so when you see these positive earnings reports, the market will rally on it, whereas these negative reports will cause people to be a little bit more downbeat. But so the results have been surprisingly strong, and obviously you can make the argument that that's backward looking from Q1. What has been surprising to us is while you've seen a lot of companies pull back guidance, we've seen an equal percentage of companies raise guidance versus lower guidance. And I don't know about you, but I wasn't expecting, more than a handful of companies to raise guidance this earnings season. What would be the, incentive to do so given all the uncertainty out there? So that's something that we can be a little bit optimistic about, given what's going on. But again, like the lagged effects of the tariff policy, we're going to start to see that going forward. And if we do see a resolution, if we start to see deals in the coming days, I think the worst of the market declines will certainly be behind us, because even though we've erased most of April's declines, we were still down about 10% heading into the month.
That actually leads to the next question. I was going to briefly touch on technicals, because you noticed something the other day about the XLK, the tech sector was up like 11% in 5 days, but it was still down 10% year to date. When you look at the technical picture, in the health or lack of health in this market, what do you see out there?
I think we're stuck in this little bit of a no man's land, which we were taught. We're between the trenches of the positives and the negatives. We've broken some downtrends from the February highs, which is something to be encouraged about. But we're still below some resistance levels. We're still below the 50 and 200-day moving averages, and so we've sort of stalled out in the last couple of days. In the market here, not necessarily stalled out, but I mean, the S&P as of Tuesday was up 6 days in a row. So I think in that respect, it's, the momentum's lowering. And so, but that just has investors questioning, oh, have we seen the best? Because, when you've seen the sharp declines of April, you're still a little shell shocked. So you're on the lookout for anything that could go wrong.
Okay. Any thoughts on other parts of the market? I mean, obviously gold's been a big story for some people, hitting record highs and then having that kind of a big reversal and pullback here. Interest rates are are in a lot of people's conversations. Any thoughts on either of those kinds of assets as well?
Yeah, so I think it's been really interesting because in the middle of the month, we saw equities selling off and we saw interest rates not going down. And that caused a lot of concerns over brand America and the attractiveness of US assets. Our view at the time was that you couldn't base a big trend like that based on 2 weeks of trading. And, there were hedge funds positioning that was causing all sorts of flux in the markets. And so when you see record volatility in equities, 10% declines over the course of a couple of days, that's going to mess things all up. It's like throwing a boulder into a pond. We started to see a normalization of the equity market and bonds for the month. What really stands out, though, is the dollar. The dollar has not recovered this month, and for the last 2 months, it's down close to 8%, which is, which is the type of decline is depending on where it finishes the month. It could be the worst 2-month decline since December 1987. So we haven't seen that kind of move in the dollar in a long time. And in some ways, the administration is getting just what it wanted. It wanted a weaker dollar, but so that's something to watch as far as how it impacts the equity market. We were just looking at this morning, and it hasn't really negatively impacted stocks. Forward returns of the equity market have actually been slightly above average, the long-term average, when you've seen a 7.5% decline over 2 months.
Okay. As we get towards the tail end of our conversation, any kind of key takeaways, things that you'd want to highlight, so the most important thing or two that somebody could take away here? I mean, are there sectors you really like, sectors you don't, stocks you like or don't, things like that? I'm wondering what you might be able to offer up.
Yeah, no, I mean, I think two things to keep in mind. First, as far as a stock and stock basis is for like, especially in the individual investors looking for the biggest winners. Like, if you look 20 years from now, the biggest winners are not going to be, I mean, who knows, it could be, but I would bet you just about any amount of money that they're not going to be the Mag 7 stocks. Those stocks have seen their gains. They've seen, the explosive growth. That's not to say they won't do well, or they necessarily have to go down. But the bigger winners are going to be found in other areas where everyone's not focusing. You go back to 2000, the 2000 peak. Those stocks, the only one that's really in the top now, as it was then, is Microsoft. All the other top 10 stocks then have underperformed the market by a wide margin. So you want to broaden your horizons and not just focus on what you're seeing in the paper or on TV every day. And the other thing to keep in mind too is, as these biggest winners, with the biggest winners of any period, and especially for the market too, you want to tune out some of the noise in things, because if I told you the stocks that were going to be the biggest winners 20 years from now, you still may not have the stomach to invest to withstand the volatility. Like a stock like Nvidia over the last 20 years saw at least 3 drawdowns of over 50%, one drawdown of 90%. So like, for any investor to hold it through that entire period would have been a really difficult endeavor if they were following the market on a day-to-day basis.
Paul, you're going to be joining us for the MoneyShow Masters Symposium in Las Vegas. We're July 15th to 17th, and that's great. I'm glad we're going to have a chance to catch up there. I know it's still a couple months off, so these things get refined. But any idea on what you give a sneak peek for somebody who's going to come, what they're going to take away from your presentation?
Yeah, so I think one of the things is what I was just discussing just now about, where do you want to look in the market for the biggest winners? Do you want to look at the largest companies or some of the smallest companies. But again, and I think what's really important from a broader market perspective about especially this period, because we've seen this record volatility and people watching it are just like, oh my gosh, like I just got to get out. I got to, lessen my exposure to the market. If you have a long-term perspective, you want to, the best course of action is throughout history has been to stay invested, as we say. There's just the longer you're, especially going out to Vegas too, on that theme, the longer you're willing to stay in the market in your time horizon, the greater the odds are that you can beat the house and outperform the market and make money. And then the second thing is, again, this is very, applicable to today, is we focus on the political idea or the political aspect of what's going on so much in the markets, especially now. And we've seen so many examples of, investors not wanting to be invested because who's in the White House, or wanting to be invested because who's in the White House. But the best course of action is do not let politics doesn't mix well with anything, but it doesn't mix well with an investment strategy by any stretch of the imagination.
Yeah. Well, listen, Paul, I really appreciate taking some time out to talk here. Have a lot to cover in this market. Viewers, if you're watching this, you want to learn more from Paul, see more about what Bespoke does, he is going to be joining us for that event. It's the MoneyShow Masters Symposium in Las Vegas. We're July 15th to 17th, and we're at an all-new venue for this year, Caesars Palace. Great location. If you've been there before, you know what I'm talking about. If you haven't, you're going to want to be there. Check out the details for the event in the description below, and you can also click to register. Paul, thanks again so much for your time.
All right. Thanks, Mike. Thanks, everyone, and hopefully see you in Vegas.